In this video, we will break down the simple rules for you to follow to get 25% return on your investments. Apart from being one of the world's richest men in modern-day history, Warren Buffett managed to transform a small investment into a massive conglomerate valued at over $700 billion today. So in this video, we are going to reveal how he built an empire by earning 25 to 50% return on investment per year on his portfolio after following these investment rules. Number 1. Invest in small cap stocks. First things first. Everyone has a little in the beginning, even Warren Buffett himself, and to start, it is very wise to invest in small cap stocks. When asked about achieving high returns, Buffett mentioned in an interview with Adam Smith that with a small sum of money, there is an opportunity to earn high returns. He suggested starting by choosing an area of interest and looking for small securities where you understand the business, occasionally finding unique opportunities in the market. Most importantly, he advises focusing on areas you are knowledgeable about and can find hidden investment gems. So it is best to choose an industry that interests you and then become an expert in it. Then, look at the small stocks within that industry that you can understand. As you go through these stocks, you will find little hidden opportunities and gems that can make you a lot of money. Remember, if the business does not sell well, the stock usually follows. So the key is to pick an industry you understand and are interested in. Then examine all the small stocks in that field to find the best deals. Number 2. Buy stocks with a moat. In investing, there is a general use of the word moat, and this deals with businesses that have a strong competitive edge. Even if more competitors try to take a piece of their business, the moat is so wide and well defended that it is hard for others to attack what they have built. When a company is very successful and makes a lot of money, it attracts competitors. These competitors want a share of the profits. A moat is what keeps these competitors from taking away customers and profits. For instance, it is tough for a competitor to replicate the giants in every sector like Apple in the tech sector, Tesla and General Motors in the automobile sector, and Facebook in the social media sector. These companies are difficult to compete with because consumers love their products so much. So when you buy a stock, make sure it has a strong moat. So ideally, you want a business with a deep moat that keeps getting deeper, meaning its competitive edge is growing stronger. Meanwhile, moats can come in many forms, but most businesses don't have one. Take a car company, for example. If a new competitor offered a 20% discount, many customers might switch, showing a lack of strong competitive advantage. Number 3. Examine USA stocks. Now this might seem like an obvious bias because, Buffett is American, but let's focus on what actually is. This strategy involves investing in smaller companies within the United States. Warren Buffett has a preference for U.S. stocks because, they made him rich, and the USA is known for being trustworthy and business-friendly. When analyzing small businesses, you need to trust the figures they provide, and U.S. companies are generally reliable thanks to heavy regulation by the Securities and Exchange Commission and other agencies. On the other hand, investing in small companies in countries like China or various third-world nations can be risky because they can't always trust the figures they release. Business practices and regulations in these places often aren't as stringent as in the U.S. Many Americans or Westerners living in these countries will confirm this. However, investing in smaller companies in other well-regulated countries like Australia, England, or Canada is generally safe. They have honest business practices and solid regulations. But Buffett will still tell you that the United States is the best place to invest in small companies. Number 4. Ensure a margin of safety. This strategy involves buying stocks when they are priced well below their highest value. You see, this is the reason why it is advisable to start up with small cap stocks. This is because they are usually underpriced during evaluation. And if you're lucky enough, you can buy stocks for a lesser price than they are really worth. Big names like Amazon, Apple, and Tesla are usually scrutinized by many analysts, so they don't usually offer the same opportunities. But with small cap stocks, you can often find great deals. The key is to know how to calculate their true value and only buy when the price is significantly lower than that value. This way, you can ensure high returns. Your goal is to buy the stock when it's underpriced, which is pretty straightforward. The less you pay for a stock, the higher your potential return. This value helps prevent the stock price from dropping too much. Number 5. Avoid going broke. Many years ago, the stock market crashed all of a sudden. This affected many investors as most stocks dropped down below 50%. But here's the thing. After a crash like that, it is often the best time to buy into the stock market. Obviously, you want to buy low and sell high. But to buy low, you need liquidity, cash or cash equivalents that you can use to snatch up cheap stocks. That is why it's crucial to have a portion of your portfolio allocated towards cash or cash equivalents. This way you are ready to seize opportunities when they arise. During a market crash, nobody knows exactly when the bottom will hit. That is why it's important to focus on what you can control, like averaging down on your positions. Keep buying stocks when they get cheaper. Even if you started averaging down around the crash period, you could still have seen a 100% return on your investments over just 10 years. Remember, the cheaper the stocks, the better the potential return. Number 6. Be different. This rule hits home, especially in today's market. There's no denying the fact that we have been riding a bull market for about 11 years now, with stocks soaring over 300%. With everyone feeling like a stock market genius, greed starts taking over. When everyone is rushing in to invest, stock prices shoot up, making it tougher to find bargains. These are the times to be cautious and not let greed cloud our judgment, just like Buffett's doing. With $214 billion in stocks and a cool $128 billion in cash, he is playing it smart in these market conditions. Sure, it might seem scary now, but when the panic hits, you can bet he will be swooping in to snatch up those discounted stocks. Forget about following the crowd, even if it seems like they are onto something. Popular opinion isn't always the wisest, you know. Buffett's big on trusting your gut. He didn't start with a pile of cash, it was just $100,000 and it wasn't even his. Some people trusted him, though he wasn't your typical Wall Street type. But here's the best part. He didn't always reveal his game plan to these people. Might have broken a big rule there, but guess what? He turned that $100,000 into over $100 million. Number 7. Exercise patience. One of Warren Buffett's key quotes on investing is, "If you aren't willing to own a stock for 10 years, don't even thinking about owning it for 10 minutes. Now, while this might seem too carefree, it is actually the reality. If you examine many top investors, you will discover they don't randomly pick stocks because he thinks their prices will go up in the short term. In fact, stocks are meant to be bought for long-term purposes. And even though many of them sometimes get bullish out of the blue, they do so for many important reasons. As opposed to the plan of making short-term wealth, most investors want to own their stocks for as long as they can. As an investor, your goal should be making profits in the long run, no matter how long it takes. But sometimes, our instincts often push us to do the opposite. We want to invest when we see others making money and sell when the market crashes to avoid further losses. Summing up what gives you a unique edge in value investing, the biggest factor is attitude. Buffett, however, loves it when stock prices drop because it means he can buy at a discount. Similarly, he embraces discounts on his favorite stocks and advises opportunities come infrequently. When it rains gold, put out the bucket, not a thimble. Number 8. The market is never efficient. Have you ever heard of the theory that the market is efficient? Well, many people believe that every stock's price reflects its true value because all information about the stock is already out there. According to this theory, it's impossible to consistently beat the stock market. Now, there are many cases of big companies whose stock fell off at some points. Now, these occurrences tend to dispel the fact that the stock market is efficient. Take, for example, in the year between September 2000 and July 2002, where Apple's stock dropped down 70%. Would this imply that the value actually fell that bad? Well, I guess we already know the answer to that. On the other hand, this period was actually a great opportunity to invest in Apple's stock. And due to these inefficiencies, big investors like Warren Buffett can beat the market over the long term. Buffett has outperformed the stock market by an average of 11% annually, which really adds up over time. That's it, guys. You've made it to the end of this video. Once again, don't forget to like and subscribe to this channel. To access other videos like this, tap the bell icon to turn on post notifications. Thanks for watching. I'll see you in the next video.